Now, WeWork's troubles continue ahead of its planned IPO. The company's target valuation does continue to slide, with CNBC reporting today that the company's IPO valuation could be slashed to $10 to $12 billion, a huge drop from the $47 billion the company reached in its latest private funding round and the $65 billion reportedly discussed earlier this year for the IPO. This comes as a slew of negative headlines have swirled around WeWork, leaving investors skittish and forcing the company to make repeated concessions. Just this morning, it announced more changes to its corporate governance structure. So who's to blame for these public missteps for a public offering? Joining us now, David Snider, founder and CEO of Harness Wealth. David has previously worked with startups like real estate company Compass and helped the tech company Sensata go public. Good to see you. Thanks for joining us.
Good to be here. Thank you.
I mean, on the surface, everyone obviously assumes it's the company itself if it's made these mistakes. But that said, to what extent is it the investment bankers that have advised them on these structures in the past, or in fact the previous investors who just didn't do their due diligence and this company was perhaps always worth 10 or 15, not 50 billion?
I think it's always challenging for a company that's sort of a category definer when especially there's a public comp out in the market. So IWG has been around for a long time. WeWork seeks to be trading at a huge multiple premium to that company, justified in part by the growth rate that it's had. But ultimately, it's really the function of the bank to be able to tell the company's executives, the bankers broadly, where should the valuation be, and also what are the red flags that are possible from a governance structure. I mean, there were way more things in this S1 than I think is typical, even for a company that seeks to have a preferred founder voting share class, like we've seen before, without a significant disruption to an IPO process.
And if they'd removed some of those red flags, do you think they could have got the higher valuation? To what extent do you think there was, in fact, an appetite just for that valuation? They could have sort of slipped under the radar if they didn't have that $6 million payment, for example, or odd governance structures.
Yeah, I think it was going to be a challenge to get the premium that they were looking for regardless, but certainly the news cycle influences investors. I mean, no one wants to be sort of holding the bag at $45 billion if the stock drops on its first or second day to a fraction of that. And so ultimately, I think you saw a tremendous amount of news coverage of, Adam Neumann owning some of the real estate leased by the company, being compensated for a trademark of We and other pieces of that. And so I think that was just a little too much in changing pre-IPO sentiment. I mean, very little is in the market about Cloudflare, which has been out today, up 20%. Datadog going public shortly, and other companies that are traditional tech businesses going public. No bad news in the sentiment, and so investors are looking at it just based on the business fundamentals.
And to that point, how much do you think this actually sets the stage for all of those companies that are in the IPO pipeline right now? I just wonder, all the governance issues, some of the other issues that have been coming out on the heels of this prospectus from WeWork, and now all the changes that are being made. I just wonder how closely all of these other private companies are watching this and potentially drafting changes to their own filings.
I think this is an outlier. I mean, you've seen other companies go public that have the dual class structure.
Yeah.
Adam Neumann had sort of 10x voting rights. It was increased recently to 20. They've taken that back down to 10.
Yeah.
It's a particularly small board, at least as they designed in the original S1. You have a very unusual spousal role, despite her having been a co-founder of the company, to have that level of influence if Adam previously was incapacitated. And so I think it was the combination of a lot of factors versus just a Facebook type structure where investors get comfortable that it's a founder-led company and there should be perhaps comfort with a different type of voting class.
And how do you think SoftBank's role in all this? I mean, are people going to now look at SoftBank and question how they value companies?
It's possible. I mean, I think they're demonstrating that if you're accompanying a great investor with the news today, that they're perhaps going to invest up to $750 million in the IPO. And so I think we'll see what happens. I think the fact that they're sticking by the company certainly bodes well for their ability to win deals. But it's definitely a challenging instance when a company's value really is derived by one major investor versus a broader-based consensus.
Do you think other property companies will be looking at them now? Are they cheap so that they're an opportunity to them, or are they just licking their lips that this threat to their traditional long-standing business model is now suffering in a way that perhaps it hasn't done for the last 5 years?
Well, I mean, if you're a traditional real estate company, WeWork's been great. I mean, they're becoming one of the biggest consumers of
What if you're a
commercial real
Compass,
estate.
which is another prop tech company that's based out of New York, which I know you've worked with as well.
Sure, yeah. I mean, I think it's a very different business. I think there's similarities that there are existing publicly traded companies, and Compass will have to show how different its economic model is. But ultimately, I think it's a different instance of a company, kind of like Uber, that really is a category-defining business, but hasn't yet demonstrated what long-term competitive advantages will come from that position, and ultimately what the path to profitability looks like.